Welcome back to The Explainer. Today we're looking at a contradiction in corporate life that, honestly, once you see it, you can't unsee it. It's going to change how you look at your job forever. Let's look at how the math actually works when the people at the top make decisions about your livelihood.
Picture this. You just watched your company buy a massive new office building, right? They're cutting ribbons, taking press photos, the whole shebang. But in the exact same week, management tells you they're on a strict hiring freeze. They literally say they don't have the cash to hire a single new entry-level worker, let alone approve your annual cost of living raise. So you're just sitting there thinking, how on earth do they afford millions in prime real estate, but they can't afford a tiny raise for the people actually doing the work?
It's absurd, isn't it? On one hand, they claim absolute poverty. On the other hand, undeniable massive expansion. It makes absolutely no sense. How can both of these things be true at the same time? Well, it doesn't make sense until you realize one crucial hidden fact. They didn't actually spend a single dollar on that building. So let's quickly reorient here. In part one of this cash flow explainer, we exposed how a company can report record-breaking profits on their income statement while secretly sitting on an empty bank account. We learned that the operating activities section is where the real truth hides for day-to-day cash. But today, we're moving past operations. We're talking about the shiny new headquarters, the massive warehouse expansions, and the brand new equipment. And the secret to how they pull this off is buried in the second major part of corporate accounting.
That section is called investing activities. It's exactly what it sounds like. This section tracks the actual cash your company spends to buy long-term assets, think machinery, real estate, buildings, and the cash they receive when they sell those things off. So logically, if a company uses its cash to buy a massive new piece of equipment or a building, you'd expect to see a huge cash outflow recorded right there on the statement.
But here comes the corporate illusion. Let's use a real, specific example to show you how this plays out. Say your company sends out a proud company-wide email announcing they just acquired $60,000 worth of brand new plant assets to expand operations. You're sitting in your cubicle doing the math thinking, wow, they just dropped 60 grand in cold hard cash? Well, no wonder my bonus got canceled. The money's gone.
$60,000. You assume it left the bank account. But if you take a step back, ignore the shiny email, and look at the main body of the actual cash flow statement for that quarter, that specific $60,000 purchase is completely missing. It is not there. There's absolutely no cash outflow recorded.
So you have to ask yourself, why? If they just proudly announced they bought $60,000 worth of plant assets, and the investing activities section is supposed to track exactly that kind of purchase, why is the money missing from the cash flow statement? Well, this is where it gets worse. The answer is a little accounting mechanism called non-cash investing and financing. Dry term, right? But it's an incredibly convenient loophole. You see, your company never actually opened their wallet. They didn't transfer funds, they didn't write a check from their reserves. Instead of paying cash, they bought those long-term assets by issuing long-term debt. Let's break down the physicality of what just happened. They walked up to the seller, handed them a fancy corporate IOU, a notes payable, and they took the building. Step 1, Step 2, Step 3. That is the entire transaction. They walked away with a brand new asset to expand their empire, and they did it without spending a single dime of the company's actual cash on hand. Now, because accounting rules state that the main cash flow statement only tracks actual cash moving in and out, this transaction doesn't belong there. Not a single dollar left the bank account. So instead of putting it front and center where everyone can see the cost, the accountants just tuck it away. They hide this massive, debt-fueled acquisition at the very bottom of the financial reports, usually in a separate little schedule or a tiny addendum note that literally almost no one ever reads. Understanding what this means for you, the person actually working there, is absolutely crucial. It means that corporate expansion is often nothing more than a visual scam. It's a carefully constructed image designed to make the boss look like a brilliant, visionary empire builder. But behind the curtain, they're just building an empire on credit, all while using the illusion of cash scarcity to keep you working harder for less pay. Just consider this logic for a second. Look at how much we're investing back into the business. Things are so tight right now, we all need to make sacrifices. Ever heard a variation of that for management? It is a masterful guilt trip. They point at the new facility, they point at the new machines, and they use the visual weight of those assets to enforce the narrative that everyone needs to tighten their belts. Look at the real picture of sacrifice here. Their sacrifice? $0 spent from their cash reserves. Their cash balance hasn't dropped by a single penny because of that building. They financed their expansion entirely with debt, completely insulating and hoarding their actual cash reserves.
Your sacrifice? A stagnant salary. You are the one paying the actual price for their credit-fueled expansion. They get the building, you get the hiring freeze.
So, here's your takeaway from this explainer. The next time your boss cries poverty while standing with giant scissors cutting the ribbon on a brand new office, I want you to ask them a very specific question. Ask them if they actually paid cash for it, or if it was just a non-cash investing activity. I promise you, the look on their face will be priceless. They'll look at you like you just grew a second head, because nobody on the ground floor is supposed to know how this works.
But this leaves us with a massive, glaring question. If the company is hoarding their money, if they aren't spending cash on running daily operations, and we now know they aren't even spending cash on buying new buildings and equipment, where is all the real cash actually going? Because it has to be going somewhere.
That is exactly what we're going to cover in the final part of this series. Next time, we're diving into the third section of the cash flow statement, the financing section. We are going to follow the money all the way to the top and expose how the stock market mechanisms are essentially rigged to benefit the people hoarding the cash.
Make sure to subscribe to support this explainer series so I can finally afford to pay my rent in actual cash instead of just offering my landlord a strongly worded notes payable.